question, a literal final exam like question, but that's not totally comprehensive. That's not drawing upon stuff from bond valuation or equity valuation or the WAC chapter. They're still going to give you your cost of capital. They're still going to give you some normal amounts. All right. But I still want to make sure that you're able to walk through it. So let's go ahead and find one of these questions together. Notice that this one is a short question, but it touches on all the topics, but I'm going to let you kind of look at it afterwards. I want to take one that's a little bit more complicated because I want you to be a pro. Give me a sec. I'll get just that. That's a medium-sized one. Okay, this is a medium-sized one and it's a good one. All right, so we're going to read through it together. And of course, everything's already identified. I'm just trying to save on time. But the steps, the actual calculations, we're going to do them together because it's extremely valuable. Okay, so this is a medium-sized question on cash flow estimation. All right, this is something that you may see on a final exam. It's something that you may see on an assessment. And to be completely fair with you, if you are a finance major, you will see this in other classes. So this is an amazing introduction to the topic. Let's go about it together. I'm just gonna get some water. I'm like at the second hour, I think, or maybe I'm just crazy. I'm only an hour in. I don't know. My voice, it's cracked. I don't know why. I guess allergies or something. Gotta do a little stretch, get into it. So Shy Designs wants to open a new office in New York. Now the project will require an initial investment of $1.15 million, i.e. today. If you are reading an exam, or if you're reading a question on an exam, or if you're just practicing, sorry, I want you to highlight this in blue, okay? Because we know that this is the initial investment. That's something that's occurring. That's one of the 6 categories that we care about. So you're going to go ahead and highlight that in blue. And what's awesome here is that because we know that this is occurring today, this is the initial investment, the present value of something happening today is equal to itself. So we could go ahead and put a little like mark here, a check mark, to say that we know that this is okay. We don't need to make any adjustments. We got the first category down. I'm sorry if my throat's all messed up. But let's go on to the next step. I'm gonna highlight this in red. So the Dubai office, I mean, this is the New York office, I guess. I'm a little bit cracked when I made the question, but not bad. The New York office will generate revenues of $425,000 at the end of year 1, okay? And cash flows are expected to grow by 9% per year until the end of the project in year 5. So notice how this sounds a little bit like our questions from time value of money, right? We have this cash flow at year 1, so we could call this like payment 1. And we know that it's growing by 9%, so we have our G. Like this is getting very similar to what we know, right? And it's payment 1 all the way to payment 5, okay? But they're also letting you know, hey, by the way, the CEO expects the operating costs to be only 20% of revenues, all right? So if our revenues, right, if they are like, you know, $425,000 a year 1, but we know that our revenues are increasing, well, by definition, if our costs are a function of our revenues, well, our costs will also be increasing, okay? So if you remember what we talked about at the beginning of this video, you understand that, well, when we're dealing with stuff like this, when we're dealing with growing payments, i.e. a growing annuity, you know that it's better to just use the formula, make this easier for you, okay? The best method. The calculator won't help you. The simple discounting method won't help you. It's just going to be way too long when dealing with a question like this. Hopefully you will use my recommendation, all right? And they're also letting you know, by the way, highlighted in red here as well, but we'll talk about it later. So also the project will require an immediate 75K increase in net working capital. Now, if you recall what we discussed previously as well, an immediate like investment in net working capital, this essentially indicates that this is NWC at year 0, okay? NWC 0, all right? Now, I'm just gonna check if I have an adjustment to make. it doesn't say it in this question, but we're going to assume that there's a recapture, okay? I didn't write it, but we're going to assume there's also a recapture, so I'll write this in orange, plus recapture at the end of the project, okay? So it's going to be even more comprehensive. So that's awesome. So we have that, so that's really cool. We understand that at NWC, so I just at year 0, we're going to invest 75K. And because we know 75K is going to be invested today, well, we already know what we need to plug in here. The present value of our net working capital is going to be equal to 75K. The reason why it's equal to 75K, it's because we know that there's only one investment in net working capital, nothing else. It's always going to be 75 grand, all right? So the reason why I'm kind of working as we're doing the question is because some of these categories, they don't require heavy lifting. Some of these categories, I would want you to be able to quickly find them on the exam. Like, yo, listen, the initial investment and the immediate investment into NWC, well, that's light work. We just got to remember that they're negative. That's it. So another thing that's important now is we could walk through, I guess, or walk towards, what am I saying? We could do the idea here is that this office in New York for Shy Designs was going to be fully depreciated, okay? It's going to be fully depreciated such that there will be no residual value. And if there's no residual value, this means that our $1.15 million is going to be essentially depreciated in its like entirety every single year for those 5 years. So to find a depreciation expense, you're going to have to do 1.15 million divided by 5. Sorry for the car outside. So that's another portion that we're going to need to work on. And then they're also letting you know that your corporate tax rate is 45%. So that's important because we're going to be able to solve for our actual OCFs with that. And that's pretty much all that we're going to work with for now. So we have all that information. So what's important here, sorry if my voice is cracking, I'm trying hard. We know that we need this to be done. So we need to solve for the present value of our operating cash flows. I'm so sorry for my voice. We know that we have our net working capital recapture that we need to work for. We know that because this project is being fully depreciated, we understand that, yo, man, you don't have any salvage value to look into. So really, if you were on an exam and you had this on your cheat sheet, like the methodology to follow through, you would go ahead and say, well, this is also done, okay? And then you would notice that, all right, there's only the tax shield also to solve for. So the reason, and my gosh, there's so many typos in my stuff right now, it's crazy. This is gonna be a reject, but whatever, we'll write that later. But the reason why this is awesome is because you notice that at the very beginning of this video, I talked about 6 categories, 6 different things that you had to walk through on an exam. You probably felt like that was overwhelming. But what's awesome here is that you notice that, yo, you know what? More often than not, I only got 3 things to calculate for. The OCF, net working capital recapture, which is like a walk in the park, and then the tax shield, which maybe requires 2 steps, but also mad easy, like these are free points. So you notice how a 6 category type of question becomes a, maybe call it like 6 manipulations that you need to do in like 10 seconds each. It's a walk in the park. That's what I'm trying to say. So hopefully this helps you kind of put it in perspective. So let's go ahead and walk through this portion here, the operating cash flows. How do we make sense of them? So of course I have the solutions here, but what I want to be able to do with you is we're going to just draw our timeline together, okay? And we're going to try to make sense of this. So I'll go ahead and I'll draw it up here. And you'll see what I mean in just a second. So year 1, year 2, year 3, year 4, and year 5, all right? But we know that operating cash flows, as you can see here, is a function of sales less costs, right? Once you have that amount, which is going to be your earnings before, I guess, your EBIT, you're going to multiply that by 1 minus the tax rate. But in this exam, you won't have Excel. In this exam, you won't have a lot of time. So what you're going to do is you're going to work smart. What you're going to do is you're actually going to understand that, yo, because we know that we're dealing with a simple and growing annuity, we could simply do this. So we know we have payment 1, and we know we have payment 2, payment 3, payment 4, and payment 5. And we also know, just to be quick, year 1. Okay, so we have our 425K. And we know that we have 425K right here. Like if you are on an exam, that's how I would look at it. And we know that that amount is growing by G every single year, right? It's growing by G. And we understand that plugging this in within our formula, within our calculator would suck. So what we could do is we could say, well, you know what? Let me find payment 1 and let me just add in, or in other words, let me find OCF1 and then let me just plug that in within my growing annuity formula. So what you would do is you would simply do, okay, well, I know my sales is equal to 425K. So this is going to be sales. And I know that my costs, well, if I go back to my question, it's 20% of revenues. So what I could do is I could do this times 0.2. And it's going to give me my cost. Or I could also find, you know what? Sales minus cost will simply be equal to 425 multiplied by 1 minus 0.2. Yeah, 0.2. Because typically, if 20% of your sales is going to be your cost, well, you could just say, you know what? Buck all that. I'm just going to do 425 times 0.8 so I can get my value to get sales minus cost. And then you're going to take your sales minus cost and you're going to multiply it by 1 minus your tax rate. In this case, your tax rate, if I'm not mistaken, is 45%. So really what you're going to have, and I'm sorry that my solutions are kind of all over the place, you're going to have 425 times 0.8. That amount is going to be multiplied by 0.55. And that's going to give you $187,000. Okay. And that will be OCF1, or in other words, payment 1. Okay. Now, once you have that, you can go ahead and plug it in within your formula, which I'm going to highlight right here. Okay. So to find the present value of a growing annuity, all you have to do is do payment 1 over K minus G. I'm pretty sure I'm doing this correct. Minus 1 G over 1 plus K power of N. So what you would do is you just plug all of that stuff in. And the reason why this is interesting is because you know what your payment is. You know that in this case, your K is equal to 14%. You know that your G is 9. You know that your N is 5. So just like that, you're able to solve for the present value in seconds. And you would notice that the present value is equal to 751,317.12. Now, I tried to walk through this with you just because I guess I wanted to make it really like clear that this is exactly what we were doing when we were looking at our stuff for the time value of money chapter. Sorry, I was just making sure the recording was still working. Imagine I was talking for 2 hours and a half or whatever, and I was talking to my wall. I don't even know what I would do. I'd be upset though. So that said, we got our value for our operating cash flows, and it was really, really easy. But I will take a quick step back. I really want you to remember that 1, this is a timeline, so we're dealing with time value of money. It's easy to solve for present value. 2, I need you to recall that you have to do sales less cost times 1 minus the tax rate, okay? And however you want to get to your operating cash flows for year 1, by all means. But just please remember that you need to make those little adjustments, that you need to do those manipulations. It's very important, okay? So with that, you're able to solve for 751,317. I'm not going to plug that in within my formula right now. There's no chance. But now that you have that, all that you got to do now is solve for the net working capital recapture. So, well, not all that you have to do. The next step is to do that. For the net working capital recapture, it's pretty straightforward. So by the way, notice how I gave you the section here for NWC, but it's really minus 75K. It goes back to the rule that we mentioned earlier. Okay, not going to spend too much time on that. It's a walk in the park. But for our net working capital recapture, we know that we had 75K that was lost in the business up until the end of the project, up until year 5. So at year 5, you're going to be able to recapture that 75 grand, right? That 75K that was lost in the business, that was trapped in the business, okay? So lost in the project, we'll write that. However, you're not retrieving 75K at year 0. You're retrieving 75K at year 5, okay? And because we understand that money received tomorrow is not the same as money that we receive today, I much rather receive money today. If you told me I'm a millionaire in 1,000 years, I don't care about that. I care about maybe today. Let's talk about today. So all jokes aside, there are a few ways to solve for this. And it's very similar to what we've mentioned earlier. So you could go ahead and use a simple discounting method, which is very, very easy. You don't even need to do a sum. It's simply going to be your payment at year 5 over 1 plus K to the power of 5. So that's one way to go about it. You could also go ahead and use your, that's also probably the best way to go about it. You could compute for the present value on your calculator, or you could use the CF function plus compute for NPV on your calculator as well. If you're going to use the CF function, just please put CO1 as 0, CO2 as 0, CO3 as 0, CO4 as 0, and then CO5, you could put it as 75K. And of course, CF0 would be 0 as well. So I guess I'll write this here. CO5 will be equal to 75K. CF0 all the way to CO4 will be equal to 0. I hope that makes sense. And then that's going to give you the present value of that recapture, the money you retrieved at year 5 as being $38,000. That's super cool. Okay. So just like that, you were able to solve for, your recapture. And how I would go about it, maybe even if I were you, is I would have like a checkbox, right? You have all of them, you identify them on your paper while you're on the exam, or especially when you're studying. And then if there's nothing, you just put 0. And then you just add your values there one by one. And then you just get to sum them up together. That's how I would do it. Like what I'm doing now. I have all of our different categories and I'm going to them one by one. And I'm checkboxing them, every single one of them, checking them up. Okay, we got that, we got that, we got that. That's how I would go about it. Now for the tax shield. This is the second time we're walking through the tax shield, okay? And it should get a little bit simpler for you. So in this we understand that our assets value is $1.15 million, okay? But that asset is going to be fully depreciated. In other words, there's no residual value. So what you're going to do is you're going to do 1.15 million divided by 5. Now, I'm not going to try to do some quick math on that. I'm going to say that, I don't even know. I think it's like 230K. I'm going to go with 330K. That's going to be our number. Hey, look at that. Hey, I'm not bad, huh? I took a lot of time to get the answer. I'm not going to lie. That was a little bit too long, but I'm okay with that. So our depreciation expense, because we know our initial investment is 1.15, our salvage value is 0, such that the total amount that could be depreciated over those 5 years will be equal to 1.15, such that our depreciation expense every single year is going to be equal to 230K. But we don't care about the depreciation expense. We care about the tax shield. How do you find a tax shield? Simple. You're going to do $230,000 times 0.45 in this case. I can't do math like that. It's going to be like $120,000, something like that. No, see, I was good with the other math. I wasn't good with this one. And the reason why I messed it up, and I'm going to let you know, is because I did times 0.55 in my head, not times 0.45. I forgot what the tax rate was. So I'm not that much of a fool trying to flex my mental math muscles. So we know that our tax shield, because it's going to be the same every year, because we understand that, and it's going to occur for 5 years. We understand that, well, of course, they won't, money received tomorrow won't be the same as money received today. So we got to discount every single one of them, all right? And to find the present value of the tax shield. Now, there's a few ways they could go ahead to do this. Now, once again, it's always the same thing. You could use the sum of your payments over 1 plus K to the power of I. So you would discount this one individually, this one individually, blah, blah, blah. Or you could go ahead and use your normal annuity formula, because these are cash flows that are occurring for a definite amount of time, and they're constant, and they're occurring at the end of the year. So you could go ahead and plug that in within your formula, at which you know that this would be your payment, phi would be your N, K would be the one that was provided, it's your cost of capital, and G would be equal to 0. There's no G, and you would solve for the present value. Or you could use your calculator. Within your calculator, you could use two methods. You could use the compute for present value method. Or you could use the the CF plus compute NPV method. Very straightforward. Listen, as I always say, all paths lead to Rome. Because of that, you can choose whatever works best for you. And boom, just like that, you get the present value of your tax shield. Very straightforward, all right? By the way, I always say this in my videos. If you feel like I made a mistake, let me know. Always happy to help, always happy to make an adjustment. That's why I'm here, all right? So let's go on and let's kind of just do a quick checkbox. So now you have all of your values, okay? Once again, I want you to understand that the present value of the initial cash investment and of the net working capital, well, we didn't need to do anything because we know that those cash flows occurred at year 0. So we don't need to discount them, such that we only had 3 manipulations to do. The one for the operating cash flows and the one for the net working capital recapture and the tax shield. Now you have all of your values. It's easy. You just add them up together, and in this case, you get minus 79,406.35 cents. And because of that, because our NPV is smaller than 0, we have a reject decision. So you would go to the CEO, you say, listen, chief, this ain't it. This is not the project. Maybe we should go somewhere else. And just like that, you know how to solve an actual exam-like question. Notice how it's really not that hard. Like realistically, 2 of the steps are free. 3 of the other steps, they're not hard. As long as you practice, you'll be able to do this in a breeze. Like I actually think that this is a question that you could solve in less than 2.5 minutes, maybe 3 minutes. It's very straightforward, okay? Because once again, all of them you could plug in within your formula. It's always a question of finding the first year's payment. That I could understand is like slightly difficult, but the rest is straightforward. Okay, not even difficult, just it takes time. All right, but now it's time for the big guns. All right, it's time to get hard with it. Okay, because we're gonna do a comprehensive exam question, one that requires several steps, more steps than you would wish that you could deal with. But although rare nowadays, if you're at Concordia, because most questions or most exams will be multiple choice, and they like to cram a bunch of questions in the exam. So I doubt that you're ever going to deal with something that big. But on a project, on an assessment, and in classes that are past an intro to finance class, you may see this. However, students at UPenn, students at McGill, students at the Ivy School of Business, you may see this, okay, depending on the nature of your course. So nonetheless, this will serve as a really, really good like final exam comprehensive review because it touches on all the chapters. And yeah, it'll help you out no matter what. So let's walk through that. I'm gonna drink a little bit of water and you'll see how easy this is for y'all, all right?